Charting the market helps you time your transactions by understanding the ever-changing relationship of news events to the behavior of investment markets. And now, with America's most complete financial overview, here is Gene Morgan.
Hurricane Gloria has provided us a respite. We can now take a look at the long picture, the big view. First, as we look at securities markets, I draw your attention to these R.W. Mansfield charts, which cover approximately a two-year time frame. We're looking first at the New York Stock Exchange composite average. And I'm going to draw a rising bottoms line from the lows, which were seen in this two-year time frame as the August 13th lows, and call your attention to the fact that we have, in the course of this past week, violated this long-term rising bottoms line. Now, we have witnessed the market in a bull market or advancing configuration for this entire period of time. Prior to this period of time, it was in a bear market or declining configuration. You witnessed at this low, seen August 13th of 1982 originally, the market's advance. Now, as we move to the Standard & Poor's 500 composite index, let us address ourselves to this time frame. Breaking out above the declining tops line, which occurred July of last year, we saw the market make its advance. In approximately 9 days, this entire advance took place, followed by 5 months, I should say, of consolidation before the subsequent advances took place. Here again, as we draw rising bottom trend lines, in the course of this past week, they were just modestly violated. The purpose of this illustration is to show where we are in the time frame. We witnessed the market breaking out of declining configuration going into last year. Last year, on July 29th, we witnessed the price lows. We witnessed 9 days of price action, followed by 5 months of consolidation, followed by 5 weeks of price action, followed by 3 months of consolidation, and we're in the consolidating phase now, but the observation is that we have violated long-term rising bottoms lines. Now, let us look at a longer time view of the market, and we're going to look first at the over-the-counter market. Same time view, I beg your pardon, same time view. In the over-the-counter market, declining tops lines prevailed. On this R.W. Mansfield chart of about 2 years, we found that going into last year, a declining tops line prevailed until we witnessed the lows seen in July. And subsequent lows were seen in December, higher lows. That's last year. So we have then the second fan formation line down. This is the first fan formation line. This is the second fan formation line, calling attention to the lessening of selling pressure and the change of direction of market behavior from down to up. Now then, here is the rising bottoms line on the over-the-counter market, which when drawn to its accelerated level has violated its accelerated rising bottoms line. Now, to view other market indices on the big picture, let us first look at the most watched index of them all, and that is the market as measured by the Dow. And the market as measured by the Dow, for the most part, has been in a trading range from the time frame from 1964 to the period when we broke out above overhead resistance, and that occurred in late 1982. Therefore, this bull market, which I want to call your attention to, lives above this rising bottoms line into relatively uncharted waters. And as a consequence of the extent of this bull market and the fact that it has an Elliott wave count of 1, 2, 3, one may say that it is becoming mature in its advance. Now, as we move down to this scale of market behavior from the time frame of 1964 to the current period of time, on the transportation index, you will find that it too is in the vicinity of its highs. Now, keep in mind that all of these market indices only recently broke out above overhead resistance. The transportation index, which often leads, broke out above overhead resistance in 1980 and has continued its advance into new high ground to this point in time. However, keep in mind that the market behavior was confined from 1964 through 1979 and 80 to narrowly confined horizontal trading configurations. Now, speaking of an opportunity that is not confined to horizontal trading configurations, we currently are the underwriter and the general partner for the reintroduction of the Pacific International Futures Fund. Many of you were invited to attend the information meetings on Pacific Financial Futures Fund, managed by a subsidiary of the Security Pacific National Bank, just a little over 2 years ago. And at the progress since that point in time is that of more than a 70% gain in the fund itself, while the Standard & Poor's 500, as a reference to the market, has experienced a gain of plus 12.3%. Well, I am pleased to advise you that the fund yesterday made a new historic high of plus a reading of 1707. So from a beginning of 894, the reading on the fund now, new historic highs, 1707. Why don't you join us tomorrow in Santa Barbara when we will host Continental Breakfast at 10 a.m. for the free information meeting on the $7.5 million offering of the Pacific International Futures Fund. We are viewing long-term price-history behavior on popular Dow indices. We have reviewed the industrials and the transports, and now let us look at the utility index. First, let us remind ourselves, the next one down, please. The utility index, seen from the time frame of 1966 to the current period of time, experienced a classic industry growth phase from 1966 to its exhaustion in price behavior, which took place in 1965. This time frame, I beg your pardon, is 1946 to 65. From 1965 exhaustion, when inflation began to take its toll, we found a decline taking place with the declining tops line prevailing until we witnessed a market shakeout in the energy crisis lows here of 1984, and that occurred in September with a retest in December. That brought price levels to the lowest levels last seen in 1952, you may recall. From those lows, we have now progressed from an oversold market condition up to an overbought market condition. And we recently witnessed a recovery from the oversold area to the overbought area. And that is approximately where we are at this time. So when values are sufficiently undervalued as they were at these lower limits, simply be reminded that yields are declining as prices advance, and prices themselves are in the vicinity of being fully, if not overvalued. That is why you're witnessing money leaving the utility market, because prices have come so far and yields are less plentiful. Now let us view the debt instruments. Let us view the Dow 20 bond chart, the debt instruments. The debt instruments. The debt instruments. Up here, please. Well, okay. The Dow 20 bond index seen on this MC horseshoe chart from 1968 to the current period of time. Let me remind you that these instruments move in trends just like anything else. There is an ascending trend channel, for example, and that embraced, as an example, a period from the lows of December of 1974 to the highs of 1977 of advancing prices and declining yields. That was followed by bonds collapsing to one-half their value, and that occurred from 1977 to the 1981 lows. Bonds collapsed to one-half their value. Now, bonds were seen to be, in 1981, at the exhaustion of inflation, at their absolute lows. Bonds, that's this point right here. bonds have subsequently experienced a very substantial advance, a correction, and a very substantial advance beyond that, to a point where they are more fully valued and there is less opportunity to the upside in bonds. Please stay in view for more market action. This report is the authority for managed accounts. It is America's clearinghouse for money management. It is dated August 1985, and I'm pleased to say that the number 2 fund of 96 funds in the nation is the Pacific Financial Futures Fund, managed so ably by a subsidiary of the Security Pacific National Bank. This fund that deals in foreign exchange, the world's largest and most liquid market, and U.S. government debt instruments, has achieved a new historic high. As of yesterday, the value was $1,707.14. And at the beginning of this fund, just 2 years ago, it was $894. Now, if you would like to learn how you can benefit from this kind of an opportunity, we invite you to join us for any one of the free information meetings that appear on your screen at this time. For example, tomorrow, we would hope that you could join us and be our guest for a Continental Breakfast in Santa Barbara at 10 a.m. That's the Santa Barbara Biltmore, tomorrow at 10 a.m. Give us a call, 1-800-GM-TODAY, if you can join us. 1-800-GM-TODAY. Now, let us view the Standard & Poor's 500 index. That index, which is the index against which money management measures its performance. The Standard & Poor's 500, viewed on this MC Horseshoe chart from 1967 to the current period of time, has, for the most part, lived within a horizontal trading range until we witness the lowest lows, which were the lowest lows seen in price history behavior of securities and debt instruments, which occurred during the energy crisis in December of 1974. Thereafter, rising bottoms lines took force. And then in 1980, we experienced a breakout above previous overhead resistance, which began this accelerated rising bottoms line. Here is the first angle of ascent. We'll count that as number 1. Here is the second angle of ascent in acceleration. We'll count that as number 2. Now, within this entire time frame, we can make it a 1, 2, 3, 4, 5, 6, 7 Elliott wave count, and simply must recognize that we are near the exhaustion, if it has not yet been witnessed, of this bull market. And we have not repealed bear markets. They historically occur every 4 to 4.5 years. Now let's move to over-the-counter stocks. First, the New York Stock Exchange Composite Index, merely to remind you that this index right here, we're on the wrong chart, this index right here. This is the New York Composite Index, MC Horseshoe chart, 1978 to the current period of time. There is the first angle of ascent in the bull market. Now, at the apex of an indecision pattern, we experienced the new bull market, which began right here, the resolution of the indecision pattern, the first leg up, which began August 13th of 82, the subsequent correction into 84, and new highs are seen. Now then, we have the second leg and the indecision pattern. Notice the symmetrical triangle here and the symmetrical triangle here. Now we will simply extend this rising bottoms line and find that price structure has just violated the rising bottoms line at this time. But this is the entire period of progression seen from 1978 to the current period of time. Now keep in mind that this is the New York Stock Exchange Composite Index. embracing everything on the New York Stock Exchange, which you note is into new historic high ground recently. Not so for the over-the-counter market. The over-the-counter NASDAQ composite market looks the same in its configuration. That is, it has a rising bottom line, same time frame, and a resolution of an indecision pattern, and the beginning of the new bull market at the resolution of that symmetrical triangle in August of '82. The bull market advanced, reacted into '84, however, has not made new historic highs, as has been the case for the senior sector of market behavior. So here is a large plurality of stocks that would normally play catch-up in the final stages of the bull market. The question simply remains, will that yet occur? Now, as we move down to the NASDAQ Industrial Index, we'll find that it has approximately the same configuration, less robust, less accomplishment, and here is the previous reference high. So this index is much lower than the previous reference high. The composite index is lower than the previous reference high, and the New York Stock Exchange Composite Index was recently into new historic high ground. Now,
the following week.
May I call your attention to an opportunity to remove yourself from those adverse factors that affect markets that you have no control over, immune yourself from the adversity of an adverse real estate market or an adverse securities market or debt instrument market. Have money employed for you in such a manner that you can weather the storm. Have a portion of your capital hedged. Here is the largest and most liquid market, the foreign exchange market and the U.S. government debt instrument market, and it is managed in such a manner that they take advantage of both advancing prices and declining prices, and the combined result is a gain of more than 70% in 2 years. And this fund, and those who've recently attended free information meetings on this fund, should be apprised that new historic highs were witnessed yesterday at 1707.14, the unit value.
Every day that the sun rises, the futures market is a huge part of our lives. From the bread we eat, to the food on our table, to the fuel in our cars, clothes on our backs, steel in our buildings, money we spend, to the homes we own. Every aspect of our lives is a part of the futures market. Investing in futures is a way to actually make money while benefiting from the very factors that may adversely affect the rest of your investments. It's all part of the dawn of a new financial age. Gene Morgan Financial, searching out the most profitable investment opportunities and opening new horizons for you. To learn more about this one, call 1-800-GM today.
Gold on this MC Horsey chart was at 715 at its high, and of course you and I both know that it was previously higher than that. But gold is living beneath a declining tops line. This is called a rally which fails, and that entitles us to draw that declining tops line. So while this was the first angle of descent, I'm now going to draw the second angle of descent. And what this is calling our attention to is ultimately the lessening of the selling intensity, because in 1982 we saw gold at 298. In 1985 we saw gold made its lows at 282, simply taking out the previous lows. But we can see that buying interest comes in the 280, 290 area. And these fan formation lines are calling our attention to the lessening of selling intensity. First, the entire sell-off of the expired growth phase in its intensity became overdone, and the rally which followed was a 50% retracement of the decline which preceded it. Now we're back to test previous recent lows. And Ultimately, we will probably have a third fan formation line out here, and that will call attention to increased lessening of selling pressure. Viewing silver on the COMEX, we find silver on this MC-Horsey chart in 1980 when silver was at $47.60 at the end of my pointer. It experienced a decline almost immediately to $11.60. A rally which failed, and new lows at $5.94 in 1982. We recently tested those lows, and I call your attention to price support. Now, the first angle of descent was this angle of descent, the second was this angle of descent, and the third is this angle of descent. Lessening selling pressure taking place. Keep in mind, we are conducting free information meetings on two different programs at the same time. Tuesdays and Thursdays, 3 p.m. and 7 p.m., we sponsor Pacific International Futures Fund, that foreign exchange fund that is making new historic highs at this time, so ably managed by a subsidiary of the Security Pacific National Bank, this nation's 7th largest bank. Tuesdays and Thursdays, 3 p.m. and 7 p.m., and Saturdays when we host a Continental Breakfast at 10 a.m. Now, in addition to that, for those of you who are seeking income, we are calling your attention to income programs on Wednesdays at lunch with a light buffet, and on Saturdays at 1 p.m. Our first income program, immediately available, is this coming Saturday at 1 p.m. in Santa Barbara at the Biltmore for a light buffet, and hope that you would join us. If you have interest in income at the 19.5% level and higher, join us for that meeting, won't you? We're viewing long-term price history behavior, first in stock indices and then in industry groups. And now let us look more at individual industry groups and call your attention to the picture here to the left of the page. This is television stocks, a 20-year time frame. You'll observe that all industry groups ultimately have this growth phase evidence. And once it is exhausted, as was the case in 1981, then stocks have simply been witnessed to have moved from undervalued to reasonably valued to fully valued, and once at the fully valued area, what is money to do to preserve and enhance itself? It must leave the investment vehicle and go elsewhere, and that's what happens. The companies continue, of course, but money leaves the stocks. The stocks decline back to a relatively undervalued area, and that is where television stocks are at this time. Let us move down to textile stocks. Textiles have been on hard times. During a 20-year time frame, declining price structures dominated the pattern. Here is a fan formation line, and there is the second angle of descent. The first is here, the second is here. That is simply calling your attention to a lessening of selling intensity. And we will draw this rising bottoms line here and find that we have in this an indecision pattern, a symmetrical triangle, wherein there is an imbalance, or a perfect balance, I should say, between the bullish forces, the rising bottoms forces, and the bearish forces, which are always pressing down, declining tops forces. Near the apex of this indecision pattern, we always find a resolution of the indecision, and in this instance it was a bullish resolution with a sharp upside breakout in 1982 carrying prices higher. The compensation for those excesses is a reaction. The subsequent was a test of previous recent highs. So we see now textiles are back to the price levels last seen in 1969 to the left of the page. This is 1969, for example, and we recently tested and were turned back by that overhead resistance line. That's that point right there, and we are testing that line again. Now let's view tobacco stocks. As we view tobacco stocks, this 20-year time frame, MC-Horsey chart, let us observe that we have a perfect illustration of a growth phase going back to 1974, bear market lows. This is a growth phase that will ultimately break to the right of this rising bottoms line and become totally overvalued. And when that occurs, dollars should be removed from that industry. Let us view the farm equipment group. You're not surprised to see the farm equipment group within its trading range for a 20-year time frame challenging lows. The farm economy is totally out of favor, and all that sector representing it is as well. Right now, you're aware that the food group, for example, is enjoying a growth phase, 20-year time frame on food and beverages. Now, keep in mind, those industry groups that are prevailing to achieve growth phase successes in this bull market will not survive likely to see growth phases in subsequent bull markets. And when this price structure that has accelerated from an undervalued to a reasonably valued to a fully valued to an overvalued area, which are the 4 steps, ultimately will break to the right of this rising bottoms line that I have drawn. And when that occurs in the components of this group, dollars should be removed from the group. Now, as we move down to gold mining shares on a longer term time frame, we might simply observe that there is in the making a very long-term indecision pattern. We're closer to the apex of a large indecision pattern. I do need to alert you that we are conducting income programs for those of you who have a need for income at the 19.5% level and above. We conduct such programs on Wednesdays for a buffet at 12 and on Saturdays for a light buffet at 1. And we hope that you might join us. For example, the next one is this coming Saturday, that's tomorrow, at 1 p.m. at the Santa Barbara Biltmore. A light buffet will be served for our income program. For income of 19.5% and more, we would encourage you to join us. Now, the following Wednesday, we'll be at Westlake Plaza Hotel in Westlake Village at 12 noon hosting a light buffet, and perhaps you can join us there. Following that, on Saturday, we'll be in Palm Springs, October the 5th, hosting a light buffet at 1 p.m. for the introduction of our income program there. I'm Gene Morgan, charting the market. We'll see you on Monday when we will have active market behavior, I'm sure. The sun will be shining and the clouds will have passed for the storm and markets will again be trading. Gene Morgan, charting the market. See you then.
You've been watching Gene Morgan and Charting the Market. For additional information on material seen or heard on this program, call area code 213-622-1234.